All right, so this is office hours for week 7, and I'm making a short presentation on the highlights and insights for chapter 7, which is all about accounts receivable. So here is a list of 10 items that you must know to be able to respond to any assessments in this course. The first is to be able to define, describe, or explain the 3 key elements of accounting for receivables, which is receivables themselves, the allowance for doubtful accounts, and the bad debt expense. Then we want to explore why credit is used, what are the advantages and disadvantages, what is the meaning of bankruptcy and insolvency. And in the case of bankruptcy, I'll talk a little bit about the process. We'll review who cares about accounts receivable and why. And then the main issue in this chapter 7 is about the challenge in measuring the future economic benefit that we present on the balance sheet or the statement of financial position in respect of accounts receivable. I'll briefly talk about the direct write-off method and why we avoid it, and then how to calculate the allowance for doubtful accounts using 2 methods, the overall percentage method and the aging method, and we'll briefly review how to process the adjustment that's necessary. Under either method, the adjustment process is the same. So we'll look at an example of processing the transaction or writing off a specifically identified bad debt, and then we'll conclude with some highlights about how to effectively manage accounts receivable so that we reduce the costs of selling on credit. All right. So accounts receivable, they represent amounts that are owed to the business entity by their customers and arise from agreed purchase and sales of goods and or services. This is a promise issued to the business entity in exchange for the provision of goods or services, and the business entity obviously expects to convert that promise to cash by collecting the account receivable, and the amount that they expect to collect is called the future economic benefit, which I'm abbreviating here to F.E.B. You'll see that reference to F.E.B. on these slides. Because there is a future economic benefit representing the collection of cash, that's what makes accounts receivable meet the definition of an asset that we reviewed in the earlier chapters of this course. So what is the allowance for doubtful accounts all about? We maintain an account that is in the asset section of the balance sheet, and it is called a contra account, which means it goes against the accounts receivable. And we use this account in order not to contaminate the accounts receivable account with estimates of uncollectible amounts. So we make our estimates of uncollectible amounts in this separate account, and because they're uncollectible and they reduce the amount that we expect to collect, the allowance for doubtful accounts account is of the opposite sign to the host account accounts receivable. Contra accounts are always of the opposite sign. Now, accounts receivable net is the way I express the difference when I'm preparing a balance sheet for clients or if I work for a company. And so accounts receivable net is not the legal amount or the sum of the legal amounts that everybody owes us. Instead, it's our estimate of the future economic benefit, meaning the amount that we expect to collect in cash from all the legal amounts that we are owed. And as a result, the amount we present on the statement of financial position is equal to the sum of the host account, accounts receivable, and the contra account, allowance for doubtful accounts. So I put an asterisk on the allowance for doubtful accounts just as a reminder that at each financial reporting date, so whenever we prepare a balance sheet, the normal balance of the allowance for doubtful accounts should be negative, so that when we add its balance, its negative balance, to the accounts receivable, we get a lower amount for accounts receivable net than the total of the legal amounts that were owed. Finally, bad debt expense is the amount that's required to adjust the balance in the allowance for doubtful accounts account before we record bad debts to make the allowance for doubtful accounts amount equal the target balance being our estimated non-collectible amounts as of the date of the balance sheet. Okay, so usually that target balance is calculated with reference to the accounts receivable legal amounts owed at the balance sheet date. All right, so let's discuss briefly the importance of selling on credit for business-to-business clients. And the reason I'm describing this as business-to-business oriented is because in most business-to-consumer businesses, consumers are paying either with banknotes, currency, their debit card, or their credit card, all of which get converted to cash almost immediately or within 24 hours. But when businesses are selling to one another, the usefulness of making credit available is to facilitate transactions, meaning we can do more transactions more quickly because nobody has to basically carry or keep on the premises a huge amount of cash. And since most businesses are offering terms of credit to their business customers, any business we're accounting for does the same thing just to remain competitive. Some of the advantages then of selling on credit is that it supports achieving our growth objective. It reduces the risks from handling a lot of cash. If we have to keep a lot of cash on the premises, of course, we run the risk of cash kind of disappearing. Now, the disadvantages of selling on credit are that we are likely to incur some bad debts because when we give other businesses time to pay, a number of things could happen to that other business, which puts them into some kind of financial difficulty and creates a risk that they might not pay at all, or they might not pay 100%. The second disadvantage is that selling on credit requires us to track accounts receivable, and that involves extra accounting and administrative costs. It may even involve, as we saw in one example in the in-class demo questions, it may even involve hiring additional staff and paying them salaries in order to manage the accounts receivable. Now, when it comes to bankruptcy and insolvency, insolvency is an adverse financial condition, which means that the business enterprise doesn't have enough financial resources to be able to pay its financial obligations as and when they come due. Bankruptcy is actually something different, and it represents the legal status of an insolvent enterprise. So bankruptcy is a process where either the people that the business entity owes money to, or the business entity itself can put the business entity into bankruptcy. And it's a protective state where the bankrupt company can try to reorganize itself and its financial arrangements in order to be able to carry on business, or if not, it will end carrying on business. So, for example, if a company goes into a status of bankruptcy while they try to reorganize themselves, there is a pecking order in terms of whom they have to pay money to, and that pecking order includes, number one is a trustee in bankruptcy. Number two is employees get to recover a limited amount of their salaries or wages owed. Number three is the taxation authority like Revenue Canada. Number four is secured lenders. And number five is the general unsecured creditors, which include companies that are selling goods and services on credit. So each of those entities needs to be paid in that order, and to administer or manage the bankruptcy process, the court appoints a trustee who looks after all of this, and what they have to do is take stock of all the company's assets, figure out what they're worth, figure out what the company could pay to their various creditors, and then the business enterprise makes a proposal to its creditors in terms of how much they can pay them. And if the creditors accept the proposal, then the company ends up paying to the creditors less than they owe, because they didn't have, remember, they were insolvent to begin with, so they didn't have the resources to pay them in full. So they propose to pay them something less. If the proposal is accepted, then the company can actually pay them the lesser amount and then attempt to continue carrying on its business. And if the creditors don't accept the proposal, then the company ends up going out of business. So because a company can sometimes recover from an insolvent situation through this method of making a proposal to the creditors, that's why in one of our examples, some accounts that were initially deemed uncollectible ended up actually submitting some kind of a check to pay the supplier of the goods and services. So they continued in business and they paid a partial amount on their debts. All right, so who cares about accounts receivable? Well, the first thing is management is very interested in this, because remember that the entity has two financial goals. It first has to survive, and then it second has to succeed. So management, being an internal stakeholder, is responsible for directing the business enterprise to survive and then succeed. Survival, if you remember from the first part of the course, is about never running out of cash. Now, the principal source of enduring cash flow for any business enterprise is cash flow from operating activities. And the only contributor to positive cash flows in operating activities is from sales. So if sales are made on credit, then collecting accounts receivable from those credit sales is absolutely essential to generating cash and surviving. Short-term creditors, the ones who short-term creditors. Okay, so they are interested in collecting their own receivables. So these are people to whom the business enterprise has accounts payable. Okay, in order for the business enterprise to pay their accounts payable, they have to get cash flow from somewhere. And again, that cash flow usually comes from cash flow from operating activities, which, as described above, is all about collecting the accounts receivable when sales are made on credit. So the only way our business enterprise could pay its suppliers if it's effective in collecting its accounts receivable from its customers. And lastly, we have long-term creditors. So by this expression, I'm usually referring to lenders who loan a company money, and their major source of getting loan payments is, again, from cash flow from operating activities. So they're interested in the company's ability to convert its accounts receivable to cash, because that's a major source of cash to make loan payments. But in addition, over and above what the short-term creditors are looking for, sometimes long-term lenders actually ask the business entity to pledge the accounts receivable as collateral for their loans. So that's why the lenders, the long-term creditors, are always interested in the net realizable value of the accounts receivable, because they want to see how valuable their collateral is in case they need to call upon it for loan repayments. All right, so one of the major factors that was emphasized in this chapter was how we measure the future economic benefits that are probable to come out of accounts receivable. So this is the concept that accounts receivable is an asset because it meets the definition of an asset, which means it has to represent some probable future economic benefits. So how do we measure that? Well, it's the estimated net realizable value from those accounts receivable. And the accounts receivables net realizable value is determined by accountants to be the difference between the legal amount an enterprise is owed minus the estimated uncollectible amounts. And when we account for that, the legal amounts that were owed in a business enterprise are what's included in the accounts receivable host account. Those are entered as positives or numbers. And then the allowance for doubtful accounts account is a negative number. And so that negative number is added to the accounts receivable host account, or it looks like a difference between the uncollectible amounts is a positive number, but it's included in the allowance account as a negative number, okay? So all of this difference, or the sum of the host account and the contra account, create what I call accounts receivable net, which means it's the expected or probable amount we expect to collect. Of course, the challenge in this is, how do we estimate uncollectible amounts? And the answer is, we base it on evidence as a combination of statistical judgment when we don't know specifically who is not going to pay, and secondarily, if we are able to identify the specific people who don't pay, which usually happens after we make a sale on credit, then we will adjust both the accounts receivable and the allowance for doubtful accounts. All right, so other than using the allowance method, there's also something called the direct write-off method. And in this method, we don't make any adjustments to accounts receivable until we specifically identify whose debt is going to go bad. And so when we process a transaction this way, we then remove the bad debt from the accounts receivable list and we charge it to the bad debt expense. Now, the problem with this, it's a timing problem that results in poor matching, because the only reason we will ever have bad debt expense is because we made a sale on credit. And so that expense only arises because we made a sale. So it's a cost of making the sale. And those costs of revenue need to be matched in the same period. If we use the direct write-off method, it's possible that we could have a sale in one period and recognize the expense in a different period. That's what creates poor matching, and that's why we avoid the direct write-off method. All right, so let's look at how the allowance method works. There's basically two steps to this. The first step is to estimate the amounts that will subsequently prove to be uncollectible. We base this on statistics like our historical business experience and our judgment, because who won't pay and how much each individual won't pay are unknown at the time we need to make the estimate in order to match the bad debt expense with the revenues that have been recognized. So there's two methods we use for this: the overall percentage method and the aged accounts receivable method. Now, when we make this estimate impacts both the statement of financial position in the way that it reduces the gross accounts receivable to the net accounts receivable, and it also impacts the statement of income by recognizing the bad debt expense and putting it in the matching period. So that's step one. And remember that when we're doing step one, we don't know at this point who won't pay. In other words, whose debt will go bad. Step two is when we are able to identify which debts went bad or were uncollectible. So this is what I call the absorption, and it reduces the allowance for unknown amounts when they become known or identified. We write off the specific amounts or accounts by taking them out of both the accounts receivable list, called the subledger, and by taking them out of the general allowance. And when this happens, the net impact doesn't affect the statement of financial position. In other words, the accounts receivable net have not changed, and it doesn't affect the statement of income. There's no impact on bad debt expense. So let's look at how much the allowance should be. When we determine the allowance for doubtful accounts, we are trying to establish the target balance. This is the balance that the contra account should end up in. And it is the amount that's necessary to reduce the gross amount of accounts receivable, or the total of all the legal amounts we're owed, to the expected collectible amount that we can present on the statement of financial position as accounts receivable net. So the allowance for doubtful account changes for allowances, that's our estimate, specific write-offs of known bad debts, as well as the recoveries of amounts that were previously written off. In other words, we've subsequently received a check from one account that we thought previously was a bad debt. So as a result of these possible changes in the allowance for doubtful accounts account, its balance can fluctuate during an accounting period such as a year. So when it comes time to prepare a financial statement, like at the end of the year, we need to make an adjustment to the allowance for doubtful accounts contra account in order to bring that account to its target balance, okay? So that adjustment amount resets the allowance account to the target balance based on the current balance of accounts receivable. And the adjustment is also the amount that goes to the income statement as the bad debt expense. So when we go to estimate the net realizable value of accounts receivable, the first thing we have to do is calculate the target balance in the allowance for doubtful accounts. So the target balance is usually equal to the total of the gross accounts receivable times an estimated rate of non-collection or non-collectability. And we did an example for this in class. It was in-class demo question number 7.3. And we had accounts receivable of $167,110. We estimated the non-collection rate at 10%. This is using the overall percentage method. So we had one rate that was applied to the total of all accounts receivable. So 10% of 167,110 gave us a target balance in the allowance for doubtful accounts of 16,711. Now, this is an example of how the accounts receivable adjustment method works. And what I've done here is I've created an exhibit that is an example of an aged accounts receivable listing. So this is what it looks like. Here's the name of the company from one of our examples. This is an age listing of accounts receivable at the year end, December 31, 2024. It lists all the accounts, all the customer names in alphabetical order, and it lists the total legal amount that each customer owes the business enterprise. Then each of these legal amounts that are owed is the sum of several invoices representing our sales to each customer. And so if we look at, for example, this account here, Better Pet Supplies and Food, it has 3 different aging amounts. And this means that this customer had at least 3 invoices, although there could be multiple invoices in each aging column. But the significance of these aging columns is that anything in the current column is not yet overdue. In other words, this all is in compliance with the terms of credit that the selling business enterprise made available to its customers. So in this particular example, the terms of credit were net 30 days. And all of these amounts that are in the current column are 30 days or less in age. But as we move to the right in the aging category, what we start to do is allocate invoices whose dates are older than 30 days. So if an invoice is, for example, 31 to 60 days old, based on the original invoice date, its value would appear in this next column. And that's why it's considered to be 1 to 30 days overdue, because it's 31 to 60 days old. If we go to the next column, these invoices are older yet, or still by another 30 days. And then the next column, another 30 days, until we get to the point where we're in the fifth column, and everything in this column is more than 90 days overdue. And that means it's more than 120 days old. So in the aging report, we distribute each customer's invoices by their age. And then once we've done it for all customers, we simply add up each column. And this is how we end up getting an aged distribution of total accounts receivable. So the gross amount of accounts receivable in this example was 102,510. And the distribution of that 102,000 by different age categories is presented by these totals at the bottom. That was the data that we were given in the textbook to solve a problem with. I just wanted to explain to you where it comes from. Now, once we have, so this is what I've explained so far. The accounts receivable aging list all accounts in alphabetical order. It distributes each customer's account or legal amount by invoice according to the date. We total up the amounts for each column after we've done that for each customer. And then we have non-collection rates that we develop the same way we had for the overall rate, but this time instead of doing an overall rate for all customers, we're doing, or for the total amount of receivables, we're creating a rate for each age category, okay? So then it kind of looks like this. We estimate that 2% of the last month's sales may become uncollectible, and the percentages increase the older the receivables get, to the point where if we've got something that's 120 days old, there's a high probability we're not going to collect it. And you can see in this case, the judgment based on experience was 60% of these amounts that are legally owed may not ever be collected. And so we multiply these various probabilities or proportions of non-collectible amounts by the legal amount owed, and we come up with these contributions to an overall allowance for doubtful accounts. If we add them across, we get 10,441. That would be the answer that you would give in response to a quiz or an exam. If I was doing it in real life, because I know this is just an estimate, I would round this to something like 10,400 or even 10,000, okay? So we multiply the total distribution of accounts by age by the various probabilities of non-collection. We get these amounts, we add them up to get an overall estimate, and then I'm rounding it. I don't want to create in the minds of people that it's more precise than it really is. All right. If we want to determine then the amount of the adjustment to the allowance for doubtful accounts, if we go back to the previous example, remember that this 10,441 or 10,400, this is our target balance. We want the target balance to bear some relationship to the gross amount of accounts receivable. So this is how we make the adjustment. The desired target balance in the allowance for doubtful accounts, which is a contra, has to be a negative number. So this is what we want to see, $10,400, which will ultimately be subtracted from or added to the gross amount of accounts receivable to allow us to create accounts receivable net, which goes on the balance sheet. In this question, the balance in the allowance for doubtful accounts before we make this adjustment was a negative 3,561. So to move the account balance from this number 3,561 negative to 10,400 negative, we have to process an adjustment of 6,839. Okay. Now, this is not the answer that we gave you in the textbook or we took up in class, because I'm using a different target balance. I'm using my rounded estimate. But if you put another estimate in here of 10,441, then you're just going to add $41 to the adjustment, which would be 6,880. That's the answer we did in the textbook. So the key takeaways from this are, using statistical enterprise history or benchmark data for bad debts and non-collection rates from an industry, let's say, we can estimate the target balance in the allowance for doubtful accounts. That's the ending balance. And then the adjustment to be processed is the amount required to move the account balance to achieve the target balance. And that adjustment is equal to the bad debt expense. All right, so when we go to process these transactions, one of the things we encountered was we may sometimes have to write off a specifically identified bad debt. When we process that kind of a transaction, we have to remember that the allowance for doubtful accounts contra account was set up to absorb specifically identified debts when they became identified. So when that happens, we're going to write off the account receivable, which means remove it, write it off the list, and at the same time, remove it from the allowance for doubtful accounts. So when we remove it from the accounts receivable, that's going to be a reduction or a negative number. And the removal from the allowance for doubtful accounts is also a reduction, but it's going to be entered as a positive number. Julian is asking, what happens if the doubtful accounts exceeds what the company says it can be? I'm not sure what you mean by that, but sometimes what happens is actual experience means that we have more bad debt specifically identified than we initially made an estimate for last year. And when that happens, then we will make a larger adjustment this year to compensate for it. So when we do this specific write-off, as I mentioned before, remember it has no effect on the statement of financial position or the statement of income. Because we are writing off specific accounts against both the receivables and the allowance in opposite directions, they net to zero. And so the impact on accounts receivable net is zero. So the balance sheet's not affected. And since both of the adjustments affect the balance sheet, there is no adjustment to the income statement. Now, when we go to adjust the allowance for doubtful accounts for the bad debt expense, you have to remember that the bad debt expense is always an estimate, okay? Because we don't know who won't pay nor by how much. And so setting up this bad debt expense using an estimate, this is an example of applying the matching principle, because we need to recognize the probable or best estimate of accounts receivable that will not be collected in the future, but we can't identify them specifically until that actually happens. But still, we have to recognize the risk of them going bad in the current period, because the only reason they will go bad in the first place is because we made a sale on credit in the current period. So that's why we have to recognize this bad debt expense and make the adjustment in the allowance every period, okay? All right, so finally, some tips for managing accounts receivable. So the first thing is, before any business enterprise grants credit, it should run a credit check on each customer. There are huge databases that are maintained by credit agencies that track customers' payments and whether they're paying on time. And you can buy a credit report from these agencies for a few dollars, and find out whether the particular customer you want to make credit available to has a reliable history of paying its obligations on time. If it does, then you can confidently extend credit to them with the expectation they will pay you on time also. But if they have a history of not paying their accounts or not paying on time, then you might want to think twice about extending them your normal terms of credit. Maybe, for example, you want to sell on a cash on delivery basis. Credit terms can be standard for all customers, such as net 30, but there is no requirement that they be the same for all customers. So you could have different classes or categories of customers, some of whom are excellent credit risks, some of whom are not such good risks. And for the not such good risks, or the worst ones, you might say it's cash on delivery. For the best customers, you might offer them 210 net 30 terms. And for someone in between, like medium credit ratings, maybe you give them just net 30. Finally, in managing accounts receivable, remember that our objective is to be able to collect cash with a minimal loss so that we have enough money to be able to pay our own obligations. So how can we best do this? The first recommendation is prepare an age listing of accounts receivable and review it at least monthly to see who's keeping their accounts up to date. Okay, if they start to be extending into over like 30 to 60 days overdue or over 90, that's when the situation gets ugly. And if certain customers' accounts are more than 60 days old, then you really want to aggressively pursue collection. And so that active attempt to collect anything that's non-current, especially if it's more than 30 days overdue, there are a number of tactics that businesses use. They issue what's called a dunning letter. Sometimes people will say, here's a friendly reminder, please pay your account on time. The second time you write the letter, it's maybe not so friendly. You may be emailing them frequently or phoning them. And then you allocate that responsibility for managing these accounts to a specific person. If you're not getting satisfaction in collecting your accounts, you can always hire a collection agency. And collection agencies are not friendly. They're very aggressive. They only get paid if they collect the account. If they don't collect it, they get paid nothing. But they may get paid a high percentage of the account. Okay. Next, if customers aren't paying their bills, then stop shipping them goods, because all you're doing is throwing good money after bad. Okay. And then finally, be sure that you are in a position to be able to charge interest on overdue accounts or offer prompt payment discounts. Both of those tactics will provide some incentive for people to pay you on time. Okay. Are there any questions related to the concepts or the practice questions or the in-class development questions related to Chapter 7? If not, I know that some people are here tonight to be able to go over some quiz questions or some midterm questions. So I just want to see kind of who's here. So we've got Amber, Julian, Victor. I know that Amber wants to review one of her midterm questions. And when we look at these things, they're confidential. So if the person who wants to review a question is happy to share it with the class, then those other people can stay here. But if they're not, then I'm going to move people into a breakout room. So Julian, what is it? Do you have anything in particular that you want to explore, either a question about Chapter 7 or a quiz or something of that nature?
No, sir.
Okay. Victor, what about you?
I mean, I came for the Excel and it doesn't seem too complicated, so I could probably build it myself. But with the
What is it, Victor? What is it that you think you want to build yourself?
The statement of accounts receivable, that little like sub ledger that you had, I think I could just make that myself, so it's all good.
All right, well, let me just put it on the screen again so you can have a look at it. And if you haven't well, it'll be in the, I'll record the video and post it up tonight. So you'll be able to look at the recording and there'll be a copy there for you, okay?
Awesome. But then also with the AFDA account, I know it's a contra, account. So like it has a negative effect on assets. What's like the best practice inside of accounting of like recording that? Like, do we need to put that negative inside of the column, or can we put it as a positive, understanding that that column has a negative effect?
You can do either one. In the world of accounting, they use positives and negatives well, they don't use positive and negative. They use something called debit and credit. And in accounts receivable, an increase in accounts receivable is a debit, and an increase in the allowance for doubtful accounts is a credit. So it really doesn't matter as long as arithmetically you understand what you're doing. The reason that I've decided to post or to describe the contra accounts always as having a negative balance is because I'm arithmetically adding the accounts together. And the way I describe them is they're married, one's positive, one's negative. So when you add them, you always end up with a net amount that's less than the host account.
Mhm.
Okay, so that's the reason I do that, because by knowing, for example, that if my convention is that all contra accounts have a negative balance, if we end up processing a bunch of changes in the contra account during the year, and before we finish our accounting and our preparation of financial statements at the end of the year, if the contra accounts have a positive balance, I know there's an error. Now, that error may simply be that we have not made our final adjustment to the contra account, because contra accounts often are about making estimates. Okay. Anyway, if you're confident in your own ability to remember, if you keep your contra account in your transaction analysis schedule as a positive balance, then you just have to be alert for the possibility that one day it shows a negative balance, right?
Yep.
Because your formula for determining the net amount to present on the statement of financial position will be to take the host and subtract the contra. But if you subtract a negative number, your net result is going to be greater than the host account, and that doesn't make sense.
Yep.
Okay.
Sounds good. All right, thank you.
Anything else?
Not from me, no.
Okay. Julian, do you have anything else you want to know?
No, I just came to get some extra information that I might have missed in the lecture.
Did you get what you wanted?
Yeah.
Okay. All right, then I'm going to, so Amber, back to you. Sorry,
Actually,
go ahead, Julian.
sorry, I just have one more question.
Sure.
It's about those two accounts. So when I was doing the reading, I noticed that there were two similar accounts for so there's allowances for doubtful accounts, which is under assets, and then bad debt expense. I'm just having a little confusion on what the difference is between the two.
So the bad debt expense, as the name implies, is an account that goes in the operating expenses section of the income statement. Okay, bad debt expense is an expense, so it's a cost of doing business, whereas accounts receivable is an asset, and the allowance for doubtful accounts is also associated with the financial statement element type of asset, but it is taken away from the accounts receivable to create the net amount of accounts receivable that we expect to collect in cash. So when we establish the allowance account, that negative amount that gets subtracted from accounts receivable, it feels like a loss. And in fact, you are losing money that you were entitled to collect. So it's that loss that becomes the bad debt expense. Do you understand?
Yep. Thank you.
Okay, you're welcome. Now, Amber, you want to go over some issues regarding your midterm?
I just want to understand where I went wrong so I can study harder for this final. If not, I don't think I
Right.
will.
Now, do you want to do that in private?
It doesn't matter if it benefits other people, or if they want to stay or leave. I'm not.
Okay, so I'm going to stop recording this because going over your test should not be made public. So let me just stop the recording.